At Insightful Value, we go after stocks the market seems to be ignoring. And right now, Coloplast is exactly that. The stock price is under pressure, but the fundamentals? Surprisingly solid. If you're looking for companies that quietly deliver results but aren't getting the love from investors, you're in the right place. This video is for educational and informational purposes only, not financial advice. Hit like, subscribe, and let's get into it. Coloplast is a Danish healthcare company that specializes in products for intimate healthcare needs. Think ostomy care, continence care, wound and skin care, and urology. It's not glamorous, but it's vital. These are high-margin, sticky markets with aging populations driving long-term demand. Coloplast operates globally and has built a reputation for quality, innovation, and close relationships with medical professionals and patients. So why is the stock trading low? There are a few reasons. First, after years of steady growth and high investor expectations, recent performance has looked just okay. In their latest earnings report, Coloplast posted 6% organic revenue growth and an EBIT margin of about 28%, which is still excellent by industry standards. But investors were expecting more, especially after the company made a major acquisition of Kerecis, an advanced wound care biotech firm. That deal raised some eyebrows due to its high cost and the potential integration risks. It's a strategic move, aiming to expand Coloplast's footprint in the United States and in regenerative medicine, but the short-term financial impact has added uncertainty. Combine that with some currency headwinds and soft demand in parts of Europe, and suddenly you've got a stock that looks stalled. On the dividend front, Coloplast is as consistent as they come. The company has paid and grown its dividends steadily for over a decade, currently yielding around 2.2%. Payouts are well covered by earnings, and even with recent acquisitions, management remains committed to returning value to shareholders. From a value perspective, Coloplast is starting to look interesting. While the stock still trades at a premium to many healthcare peers, it's cheaper than it's been in years. And that's despite stable margins, solid cash flow, and a long-term tailwind from demographic trends. But there are real risks to watch. The company's premium pricing model depends heavily on strong reimbursement systems, especially in Europe. Any regulatory shifts could impact margins. Also, integration of Kerecis is a big test. If it doesn't deliver, investor confidence could erode further. On the other hand, if Coloplast executes well, the upside could be meaningful. The company is quietly positioning itself as a global leader in a niche but essential category. That kind of specialization, combined with operational discipline, tends to pay off over time. Will the stock recover soon? That depends on how well they prove the Kerecis deal was worth the price and whether growth in newer markets picks up. But the base business remains strong. And for long-term investors, the current weakness might look more like a buying window than a red flag. At Insightful Value, we specialize in exactly this type of analysis: undervalued, overlooked companies with strong fundamentals and misunderstood stories. We cut the noise, break down the key data, and make it easier to understand why these names are worth a second look. For more like this, check out insightfulvalue.com. And don't forget to subscribe to our channel and like this video if you found it helpful.